The Executive Board.
KBC English Service.
The Executive Board. Economic analysis, perspectives and debates on KBC English Service.
KBC Nairobi.
Wamoyi Masila sits in the executive room with experts and decision makers as they share their perspectives on the economy.
On the Executive Board, we focus on the just released Knight Frank Wealth Report, Kenya edition. The focus is also on investment trends of wealthy Kenyans in the real estate sector. Our guest is Mark Dunford. He's the Chief Executive Officer. Knight Frank Kenya is here to discuss in details about the report. The Executive Board is a three-part interview that looks at challenges, the status, and untapped opportunities in each and every sector of the economy. The executives on the show also have a chance to explain about their profile and their winning game plan or strategy. Let's get underway with the Chief Executive of Knight Frank Kenya, Mark Dunford.
I am a proud Kenyan. I've been in the real estate space for over 20 years now. Not always purely focused on real estate or vanilla real estate assets. I started off my career looking specifically at hotel real estate, and then merged into kind of more diverse asset classes, and then became a kind of generic leader for a couple of companies. And then now I've ended up here back home as the CEO of Knight Frank in Kenya. It's been 3 years now, almost 3 years that I've taken over the helm, and it's been an exciting 3 years for us. We are shaking things up. We're starting to look at new and diverse ways that we can add value to our clients, starting to embrace the tech revolution, look at ways we can automate a bit more, create more efficiencies for ourselves internally, but also for our landlords and our clients that we represent out there in the market. So it's been an exciting 3 years. It promises to be an exciting 3 years ahead, particularly as we become a more unified Pan-African business. Knight Frank, we're the biggest real estate advisors across Africa. We're in 10 different countries physically, but we work across pretty much every country in Africa, the ones that we're allowed to anyway. And we now have since last year, a Pan-African strategy that was put together by myself and my colleagues across the Middle East, our head office in London, and our African peers in countries as far away as Nigeria and South Africa and Egypt.
Let's look at your game plan as a CEO. How does it look like?
Look, I think the market is increasingly competitive, not only in the real estate space. I think everybody's feeling that with digitization and the way the world is moving faster and faster, there's increased competition. You've got to be much more proactive rather than reactive. I think a lot of firms have been reactive historically, particularly in the Kenyan market, and particularly when you are at the top of the market. You can become a little bit complacent, sit back on your laurels and not be too energetic. We have a fantastic young workforce here at Knight Frank, so I'm trying to create an environment which empowers them to push the boundaries and do what's best for us as a company and what's best for our clients, and that managing our costs is very important, but growing our revenue is equally as important, right? There's no point having a very streamlined cost structure if you can't increase your revenue or keep revenue if you have no income. So we're looking at all sorts of interesting, diverse ways that we can market ourselves and grow our revenue.
Someone listening to you would say the CEO on the show today, he has achieved a lot. What motivates him to wake up every morning and go about doing his work?
Anybody who achieves a certain level of office or position within the sports world has an element of insecurity to them. So, I think that fear of failure is what motivates me anyway, to get up in the morning and try and do the best I can, or at least do better than I did yesterday. And I think that's, if your aim is to do a little bit better today than you did yesterday, it grows incrementally into a big change, right? So I think that's my big motivation. I've also been big on the idea of giving back, and I've been blessed with the opportunity at a very young age to climb the ladder and travel and work overseas and study overseas. And I think there's an obligation for myself and my peers who've had the same opportunities to come back to the local market here and pass on that knowledge, help grow the local market in a way that it doesn't need to depend so much on international exposure.
This is the Executive Board, economic analysis, perspectives and debates on KBC English Service with Wamoyi Masila.
Away from the profile, let's move on to today's topic, where we're looking at the investment trends of wealthy Kenyans in the real estate sector, their habits. What do you make of that report in general?
The wealth report globally is a kind of cornerstone of Knight Frank's knowledge, thought leadership piece. So we've done, since 2007, 19 editions now globally, and we work with over 200 countries and territories and wealth managers and massive global banks, private equity houses across all those markets to garner information. A couple of years ago, we had the thought here in Kenya that Africa, and particularly Kenya, is only a kind of footnote in the main report. And so we thought, we have a big enough market here, let's start to do our own. So we did one last year, that was our first. We've done a second one this year. We've largely kept the questions the same to start to build a data set, right? As time goes by, if you ask similar or the same questions, you can start to see the trends. If you change the questions every year, then you lose that ability to see trends. So the data set is largely the same. We are looking at feedback from people like yourself and the media and the questions that you guys ask us. We try to look at what questions you're going to ask and think about our responses and make ourselves look clever. But there's always one or two questions that come up that stump us or trip us up, and then we always think, okay, we need to factor that into our next edition and see what questions we can ask to get those answers for you guys and for obviously your readers or your listeners. But yeah, this is the second report. It's here in Kenya we have over a dozen contributors this year who are, again, private banks, private wealth managers, and it's quite a big cross-section in terms of the size of their portfolios that they oversee and the number of clients that they oversee. So we have about 70+% of them oversee portfolios with more than 50 clients. 11% have more than 500 clients. Of those clients, 55% of them have net worths of above $20 million US dollars, and 5.5% of them have more than $1 billion in net value. So that's a lot of money, and it's a big cross section. We are obviously beholden to certain restrictions vis-a-vis confidentiality, or should I say, the people that we survey are, and there's always a skittishness from the wealthy vis-a-vis disclosing information. So there's only so much we can ever gather and so much we can disperse. Yeah.
Okay. So new findings from the report.
I think the big change since last year and since the previous years of being part of the main wealth report is that here locally but also internationally, people are looking away from real estate. And not entirely, but they're looking at alternative investments that return them better yields than the current real estate market. And there's a few reasons for that. Here in Kenya, largely the problem in sub-Saharan Africa is the cost of debt, the cost of financing, and the cost of development here locally has shot up. So a lot of investors are sitting on their hands. I think it's worth mentioning also that these are private entities that we're surveying here. This isn't institutions. So institutional investors look at things slightly differently. Private investors don't tend to have quite as much capital to deploy. They're also making decisions much faster, so they can be more reactive to market shocks and more proactive as well. And depending on their personalities, they can be more risk-takery. So, I think that the big one has been that this move away from vanilla real estate assets, the traditional, build a shopping mall, build an office block, build a bunch of houses, to either completely away from real estate into alternative asset classes or into investment assets or into alternative asset classes in real estate.
There's also a finding about reduced activities in comparison to the previous year. What exactly happened? What were the underlying factors?
Yes, we've seen a reduction in wealth according to our survey. We've seen I think there's a silver lining that I'll comment on as well. So we've seen a reduction in the total wealth of these portfolios by about 10% year on year. And we saw that reduction the year before as well. And I think there's a few reasons for that. One is people are moving money offshore, and that's not anything new. In uncertain times globally, people have looked at markets such as the UK and continental Europe to go and buy assets or invest in, because it's seen as a more stable market. The currencies are more stable. So we've seen that for years and years. What we're seeing now is Dubai has emerged as one of those markets. It's slightly more risky, obviously, than continental Europe, or at least the perception is that it's slightly more risky than continental Europe, but a lot of money has moved that direction in recent times. And if you just look at the amount of Ukrainians and Russians who've moved to Dubai and have invested in Dubai, that's a clear sign that it's not just a Kenyan trend. I think the other piece to the whole thing is that, like I said earlier, uncertainty leads people to reconsider their investment decisions and maybe sit on their money a little bit, or invest in things that don't necessarily appear on our real estate radar. So the other asset classes such as gold and fine art and so on. So that the kind of longer term, more stable investments.
This is the Executive Board, economic analysis, perspectives and debates on KBC English Service with Wamoyi Masila.
Our guest is the Chief Executive Officer of Knight Frank Kenya, Mark Dunford. They just released the report, the Wealth Report 2025, and that's what you are looking into in details. We're trying to explain here what it entails to you, the audience. In the second part of the interview, we want to look at the economic environment in Kenya, where Kenya still is a preferred area by most investors. Could you just comment about the economic environment, the operating environment in Kenya for the real estate sector? Sure.
I don't want to get myself in trouble by saying anything too bombastic, but it is a tough market out there right now. Your average Kenyan is feeling the pinch, and that has knock-on effects. A lot of people don't realize that if your take-home salary or money at the end of the month goes down, then the amount of people going to the supermarket goes down, or the frequency that you go to the supermarket goes down, or what you buy there goes down, right? You don't buy as much necessarily, or you buy lesser brands, and so that then obviously has a knock-on effect to the retailer, that then has a knock-on effect to the entire mall or shopping center that it's within, because the revenues are all falling down. The less footfall you have, the less disposable income you have. There's a knock-on effect there. So there's a lot of it's a big web. It's not as simple as saying, well, interest rates are at X, so that means Y. The reality is that there's a lot going on, and there's the domestic element that is controlled by our government, but there's also the element of international decisions that impact our economy. A big one recently has been what's been going on with the USAID. We're not 100%, we're a long way, I believe, from understanding the full impact of that decision. And there's a lot of rumors in the market about, different agencies coming in and certain agencies leaving and layoffs happening, and all that again leads to that word uncertainty. And when there is uncertainty, if your prospective job might disappear, you're probably less likely to spend money in an extravagant way as well. So there's, that, like I said, that knock-on effect is far-reaching. The agencies here locally that may not be seen as directly, or they may not actually be directly funded or financed by the US government, however, they rely on contracts or contracts from contractors of, that knock-on effect downstream is far-reaching, and that's pretty tough. I think if we're looking closer to home, the biggest issue we have is the cost of financing, and that kind of disposable income level, right? So if you're, and there's also the supply and demand metrics to this whole thing. How many apartments can Nairobi really sustain, right? How many, and in what sector? Are we truly building these affordable houses? And if we are people actually going to buy them? These are all questions that we're waiting to see the answers to. There's obviously a massive demand for affordable housing. That's not a Kenya-specific issue. The World Bank has said that they believe there's going to be 900 million people in sub-Saharan Africa living in urban areas, which is 60% of the population by 2050. That's a massive market. And that's the good news, is that our market is growing, our urbanization is growing, so there's more and more people moving to cities, which means there's more and more demand. But the question is, at what level is that demand, right? And how much does it cost to build that stuff? And then what do you have to sell it at to then service your debt? So it's a tricky environment out there at the moment, and that's why, and it sounds like a plug, but...
And why is it that Kenya is still a preferred destination by investors in the real estate sector, based on your report for the last 2 years? Despite reducing by 61%, the other year was 66%.
And again, and I don't think this is going to end up being an uncommon trend if we look overseas, that people tend to prefer to invest, particularly in more challenging times, closer to home, right? They know the market, they understand it better, it's less risky, right, from their perception. So because they can actually literally see the assets they're investing in, they can manage them day to day, they can go around and see them and check that the team who's overseeing that asset is doing their job correctly. So that security element in an uncertain time increases the local investment. It's an interesting one because we're not sure whether it's that or an increased confidence in the market. I mean, on the increased confidence piece, we're still a very strong growth market. East Africa, Sub-Saharan Africa, East Africa and Kenya specifically, our growth rates are certainly above the rest of the world on average, right? So in a way, that's a great thing. But I think it's primarily also that, where else are you going to go invest right now? Europe's expensive, Dubai's expensive, they have their own problems. The markets globally are pretty uncertain. We saw an interesting trend though, which I think is relevant to this, is that those second homes that people are buying overseas, up until last year, it was typically the UK, Canada, South Africa, that Kenyans were buying secondary homes. This year we've seen the USA leapfrog all those other markets and become a market that Kenyans want to and have bought secondary homes in. And I wonder whether that's a reflection on the perceived security of a Trump government. I don't know the answer to that, but you would think that's what's really changed since the last time we did this, right? A year ago, Trump wasn't in the White House. Now he is, and all of a sudden Kenyans are buying houses in the US. So it could be a perception that the US market is quite stable. Or at least it was when we did this report, prior to the tariff wars that have started now.
When you did the report, looking at the returns in the home sector, how was it like? And also moving forward, expectations?
Yeah, I think it's worth mentioning that historically, so even last year's report, we saw Kenyans buying secondary and tertiary homes for the sake of having them. So they were either places, if they were overseas, they were places where their children were going to study or that they would like to holiday because their children now live and work. Here locally, it was places that either it was at home, as in their rural home, or somewhere that they could go for a getaway, so the coast and other kind of secondary markets. Now, the big shift has been that we're seeing people want to yield revenue from those properties, right? So when the return before was based purely on capital appreciation, or not purely, but largely on capital appreciation, people were buying a house, they weren't living in it, they weren't renting it out, they were going there once or twice a year or even a couple of times a month, and that was what they were doing with it. Now they're saying, these houses are sitting vacant, or these apartments, I can buy them and I can rent them out and I can make a return from them. So the returns are pretty good. It all depends on your capital stack and how much you've borrowed and in what currency and what rent you're achieving. And the shilling did a very interesting thing last year where it strengthened against the dollar. I don't believe the shilling has strengthened against the dollar like that in memory, to be honest with you, especially following, directly preceded by such a sharp fall against the dollar, right? We went from 120 to 160-ish, and then we went straight back to 130, 129. And that swing, I don't think we've seen it, at least as long as I've been able to remember. And that's done some interesting things to people's returns, yeah.
This is the Executive Board, economic analysis, perspectives and debates on KBC English Service with Wamoyi Masila.
And today we're looking at the investment trends in the real estate sector, also tying it to the report that was just released by Knight Frank Wealth Report of 2005. In the studio we have Mark Dunford, is the Chief Executive Officer, CEO of Knight Frank Kenya. Away from the returns you've just talked about, let's look at the investment habits of the wealthy people in Kenya. How would you describe them?
Wealthy individuals didn't get wealthy by sitting back and doing nothing, right? Most of them have taken some sort of action and taken some sort of risk. So at the moment, we're seeing this trend where the wealthy are looking at alternative investment classes away from real estate, a little bit more entrepreneurial, maybe a little bit more service sector oriented, IT automation. We have a very well-educated, very entrepreneurial youth here, and I think some of the wealthy are starting to look at that and go, there's opportunities here, right? Much in the same way that I mentioned earlier, we have this really entrepreneurial, really strong, youthful team at Knight Frank. It's a similar type thing on a broader scale. At the same time, there's alternatives in the real estate world, right? We're leapfrogging where some of our markets, kind of aspirational markets, if you want to call them that, the Johannesburgs and Dubais of this world, who are ahead of us on the development cycle. We're leapfrogging what some of them have done. We're learning, not always, but we're trying to learn from their mistakes and move to alternative asset classes that support this growing economy, growing population, and take advantage of some of the more eccentric opportunities that are out there. I think an example is something like a data center investment, and data centers come in many shapes and sizes, and some of them are slightly smaller and are called co-location centers, where you have multiple tenants occupying a co-location, and then you have the big mega sort of hyperscale ones that are usually one big tenant comes in and they cost hundreds of millions of dollars to build and just drink lots of electricity. And we've seen local investors investing in smart industrial, green industrial parks, smaller logistics facilities, food storage, even agri, if they want to be vertically integrated. Some of the more agricultural investments are popular for a few reasons. One is ESG. ESG is a buzzword that is very much no longer really a buzzword. It's now a cornerstone of most investments. And the food security required for a growing young population in Africa means that there's demand for agri and homegrown agri downstream. So yeah, I mean, your investor is still, I guess, like any investment portfolio, there's elements of traditional asset classes. People still buy land, people still build office buildings and malls. Yeah. I think we're seeing a move to more mixed use. Mixed use is popular because you're de-risking to an extent, because you don't just have one asset class. Yeah. You have a bit of office, you have a bit of residential, you have a bit of retail. So if one isn't doing too well, the other one hopefully makes up for it, or the other ones hopefully make up for it. So, but again, the lot sizes are quite small because these are individuals or wealthy families that are investing. These are private investors, so they're not going out there and spending $100 million of their own money building things. Very often they're typically spending $1 to $5 million building a small roadside strip mall petrol station with some retail and some apartments, those sorts of investments. Yeah.
Okay, that's what they say. You don't have to put all your eggs in one basket.
Exactly.
Untapped opportunities in the real estate sector.
Yeah, I'm a big believer in logistics. I think e-commerce has started, through COVID, it really grew everywhere in the world, but also here in Kenya. And with this big and growing middle class in Nairobi particularly, there's a logistics need. And I believe there's an opportunity there that's being looked at by a lot of people. Obviously, ALP already exists, and there's a couple of others out there who've set up and have really paved the way for that industry. But I think we're just seeing the very beginning of what's going to happen vis-a-vis the logistics, distribution, food storage space. If you look at other developed markets and how much real estate is attributed to that, it's considerably bigger proportion than what we've got here in Nairobi. And I'll caveat that by saying we have a lot of light industrial space, but some of it is no longer fit for purpose. This is very old stuff that was built, in the 70s, 80s, even before some of it. So it's a time to upgrade a lot of that and replace some of it.
Funding, the sources of funding to support the investors in the real estate market, looking at the stock markets, stock exchanges across the world, the business of REITs, real estate trust funds.
Wave of REITs we saw were maybe a little bit premature. A lot of the value that a REIT can create is derived from the assets within that REIT, and we're now starting to see REITs with investment grade assets in them. There's some obvious case studies now, and there's more interest to create those REITs. So that's one avenue, obviously. Along with REITs comes regulation, back to that ESG word. And whilst on that ESG topic, there's still the DFIs out there, the likes of the IFC and other DFIs that invest in specific types of real estate, but they have very stringent requirements vis-a-vis your ESG, right? They want some sort of social element. They certainly need the environmental piece. So there's talk of green funds and green financing coming in a meaningful way. We haven't really seen that yet, but I think if you look at a balance or a mix between obviously your equity, what you can then get from a commercial bank, and then what you can get from a DFI, let's call it, and kind of balance those elements, you can structure something quite good. I mean, we as Knight Frank work with a lot of Pan-African investors and even global investors who are looking at the African market, and we help them with their conversations around financing, both here locally and then with the kind of global teams of some of these bigger lenders.
Your parting shot, your advice to that investor who is jittery: when should I invest in this real estate? Is it the right time to take up an investment in the real estate sector?
Good question. Looking back over my time in the real estate space, which is quite a long time, I've only seen a handful of situations where people have really regretted investing now and have sat on their hands and waited. Most people who invest now rather than waiting tend to end up doing okay, right? So my suggestion is get the right advice, because particularly as the market tightens a little bit around these cost elements, building the right thing in the right place for the right demographic or target group is essential. So, yes, there's still people building hotels in New York and in Tokyo, even though there's tons and tons of them. It's because they know there's a gap in a certain very niche place. So you need to do more pre-work before investing than you used to. Gone are the days of just building something and they will come. Now you've got a lot of competition out there, a lot of supply. So you need to get the right advice.
And we have to come to the end of this interview, the Executive Board and KBC English Service, where we looked at the investment trends of wealthy Kenyans in the real estate sector, pointing at the report that was released recently by Knight Frank Wealth Report of the year 2025, the CEO, Mark Dunford. Thank you for your time.
And thank you for having me. Always a pleasure to be here at the Executive Board.
Wamoyi Masila sits in the executive room with experts and decision makers as they share their perspectives on the economy.
KBC English Service.
The Executive Board is also available as a podcast on www.kbc.co.ke.
KBC Nairobi.